Welcome back to the channel. A lot to unpack, a lot to talk about this week. I apologize for the delay in the video. We did have another video ready to go, but unfortunately there was an issue with the file being corrupt. Weren't able to upload it, so here we are. But I wanted to basically talk a little bit about the Bank of Canada's next rate announcement on December 11th, coming up next week, what's happening with fixed rate mortgages, and we'll do that in just a moment. But a lot of questions, a lot of clients coming back to the table right now, especially with mortgage renewals. In 2025, we're projected to see around about 1 million mortgages renew plus in 2025. And ultimately, if you have a mortgage renewing at some point in 2025, getting ahead of your mortgage renewal at least 3 to 6 months is going to help you keep thousands of dollars in your pockets, and you'll know why near the end of the video when I talk about what's happening with these rates. The other thing super important to understand is Canada Post is on strike. If you have a digitized portfolio, if you have your bank statement sent to you electronically, if you're banking everything online, you're able to download all that stuff. Super easy, no problems. But if you are one of those individuals that do still get print statements, mortgage statements, so on and so forth, expect those delays. That can obviously impact you if you don't have them, because ultimately, I know switching over bank statements sometimes, especially if you bank, your day-to-day banking is with one of these online providers, right? Those companies that are not brick and mortar. We've heard complications about getting statements. We've heard clients mailing out checks, and ultimately, depending on how you do your banking, understanding the Canada Post delays could impact your renewal, especially if they continue on. Hopefully, this is resolved really quickly, and all this conversation is in vain. But ultimately, if you are approaching mortgage renewal, you don't have digital copies, make sure you're getting ahead of it. Try to switch over in case you need a few months of bank statements. Sometimes it takes time for them to upload those statements onto your actual online portfolio on your actual app. So understanding that, super important. We've seen some delays there. One other thing too, super important, a lot of clients coming to us talking about refinance, restructuring their mortgage, especially those that have rates that are over 5%. So if you are a mortgage holder with a rate that starts with a 5 plus, and you thinking about, hey, what does this mean if I get into a lower rate? Obviously, you can wait it out, see what happens with interest rates in the next short term here, short to midterm. But we are helping a lot of our clients keep thousands of dollars in their pockets, even when they have to maybe pay a penalty, whether it be 3 months or interest rate differential. Running the math, seeing if it makes sense for you, first and foremost, and also considering paying off a lot of those higher consumer debt items like credit cards and lines of credits, helping keep thousands of dollars in their pockets. Even if you have to switch to a different lender, we do have some significantly lower rates than 5%, obviously. And we'll do a rate update on the channel in the coming weeks ahead as soon as we get some stability with these fixed rate mortgages, which leads me down to the next part of the conversation is 3 of the major banks in Canada of the 5 have increased their fixed rate mortgages on their 3 and 5 year products. A lot of their mortgages have gone up 15 to 20 basis points from where they were previously. And ultimately, that means that, hey, are we going to see the other banks follow suit? Some banks are on the gas, some banks are on the brake when it comes to being competitive, even though we hear and see, mortgage rate wars being a thing. Yes, they are definitely, mortgage origination is down across the board. So banks are trying their best to keep their existing clients. Always cheaper to keep an existing client than to acquire a new one. But at the end of the day, a lot of some of these banks, some of these broker-friendly banks, not being really or cannot be as really aggressive as some other banks. So making sure you are talking to a mortgage professional, getting those options can help you keep thousands of dollars in your pocket. But if you think about it, okay, fixed rate mortgage, we anticipated them to come down over the next 3, 6, 12 months. And I do believe over the long term, come after January 20th, once we start to see what happens in the US with the president-elect coming into power, how his deregulation, his policies, if we see those tariffs, how the economy looks for the US, for Canada, and other countries across the world. Well, that will also determine where bond yields in Canada end up resting. So the major reason for the fixed rate mortgages going up, once again, very important to understand, fixed rate mortgages move on bonds. Very simply put, 5-year Bank of Canada bond is a good barometer of where fixed rate mortgages are headed. Over the course of the last few months, we've seen those bond yields tick up 30 to 40 basis points. they've held at a higher point for some time now. Some banks are finally adjusting. So they have moved those rates up. Does that mean the other banks are going to follow suit? What's happening in the US Treasuries ultimately with what they think is going to happen with a Trump administration, inflationary pressures, yet to be determined, but ultimately that can change very quickly. But variable rate mortgages move on the Bank of Canada policy rate. So when Governor Tiff Macklem comes out and talks on December 11th and says, hey, it's going to be a quarter or 0.5% cut, that doesn't mean the fixed rate mortgages are going to move down in conjunction with that adjustment. That is two different, there's two different means, there's two different vehicles by which these two rates are determined. Bank of Canada helps move the needle for variable rate mortgages, lines of credits, anything based on the bank's prime rate. Fixed rate mortgages move on bonds and what's happening mostly in the US with US Treasuries. So just make sure that that is very clear. And then ultimately with the Bank of Canada meeting next week, well, what do we think is going to happen? Quarter, 0.5%. If you would have asked me, and what I talked about in my previous video that was not uploaded was be prepared for a 0.25% with a upside of 50 basis points, depending on what happened with these job numbers. And unemployment ticked up to 6.8%. Economists had it pinned at around 6.7, but it was around 6.5. So seeing this number tick up after being pretty static does give the Bank of Canada the additional ammunition it would need to cut 50 basis points. Now, if we say that's +1 on the data point, inflation, well, it's at 2%, right? We know the Bank of Canada said, other central bankers have said that inflation is subsiding, even though we don't maybe see it as Canadians when we go to the store or, when we're buying things, but inflation is pulling back across the globe. And so even though we have this potential fear of inflation, we have to understand that if it stays at 2%, that's what the Bank of Canada wants. Below that, deflationary. Above that, problematic. Sweet spot, 2%. So we're at 2%. We'll see if the Bank of Canada really decides that they are happy with that. But I would say 2% inflation, unemployment at 6.8, +1, that's +2. Now, +3 for the Bank of Canada to cut 50 basis points could be the fact that growth in the country has stalled out. 6 to 7 quarters of contraction or negative growth, not meeting expectations, right? The Bank of Canada had forecast at every meeting that they wanted to see growth 1.5%. Most healthy economies have growth at around 4%, mostly 3 and 4, right? I mean, you can pick and choose what number you want, but anything over 1%, right? We projected 1.5. That's what the Bank of Canada projected. Forecasted 4, came in at 1% last week. Okay. Let that sink in for a second. Growth, productivity, GDP per capita, Canadians are feeling less eager to spend, less wealthy. We are outpaced by our counterparts in the US when it comes to incomes. That is literally the case from what I hear from a lot of business owners when it came through Black Friday, Cyber Monday, extending sales, abysmal compared to the years prior, obviously, because most Canadians just don't have it. Now, there's some that do, some that don't. Obviously, that offsets it when it comes to the numbers, but for the most part, we definitely believe we are in a recession. And, it doesn't take a rocket scientist to figure out. I mean, the former governor of the Bank of Canada, Stephen Pulez, came out talking basically publicizing that we're in a recession with those 6 to 7 quarters of contraction or negative growth. I mean, what else do we need to see? I mean, most Canadians already know we're in a recession. Unemployment's ticking up. Economy's not growing. We have immigration concerns, obviously, as we have more people in the country that sort of camouflage the problem, right? More people in the economy, right? So you have X amount of people, you add a couple million, that means more people spending in the economy. That means the growth numbers, the expenditures, the GDP that our wonderful Minister of Finance there, or Deputy Governor, what's her name, Chrystia Freeland, has so been happy to talk about. GDP in Canada is amongst the G7. BS. It's all BS. It's all basically inflated through immigration levels. It's all done through population. We don't have the backbone for the productivity, and I guess the whole point is that if we see millions of people now leave, hundreds of thousands, a million people leave, students, foreign workers, temporary workers, all these individuals, if they end up actually picking up and leave, what will that really do to the growth number here in Canada, right? We'll actually get a true picture of it. And number two is, will these people actually leave? I mean, who's enforcing who in the government's going to enforce these people to leave? Is it going to be Canadian Border Security? Is it going to be the RCMP? Who's going to force these people to leave? Who's going to basically do that? Is it here in Canada, from what I understand, it's an honor system. Oh, you said you're going to come here for 6 months, a year. Once your work permit expires, you're going to leave, or you're going to jump over into the US, cross the border. What's going to happen, right? Who's really going to force you to leave? Especially if you think about a lot of these people that have left their country, sold off their assets, cars, vehicles, homes, come here with the intent to stay here forever. What's the likelihood of them leaving and going back to their home country? Are they going to apply for refugee or asylum status here in Canada? And ultimately, we'll see how that plays out. But at the end of the day, I do believe that the Bank of Canada will potentially cut 0.5%. If you are a variable rate mortgage holder right now, that sounds like music to your ears. Maybe Christmas comes early. Ultimately, we'll see what happens next week. Will we see a quarter or 0.5%? Regardless, a quarter is baked into the cake. Next week may see 50 basis points. Don't be surprised if we do. Let me know what you think in the comments section below. But until next week, thanks again for stopping by.